Okay, so you're driving down the road, you see a sign, maybe it's a Sunoco sign, you probably just think, okay, gas station, right? But what if I told you that behind that familiar pump, that logo, there's this massive, really complex energy infrastructure company, and they're making some huge, potentially transformative moves right now.
It's absolutely true. Yeah, it's a world that's much more intricate, more expansive than just those retail fuel stops we all see.
Exactly. So today we're doing a deep dive into that world. Sunoco LP, ticker symbol SUN. They're structured as something called a master limited partnership, or an MLP. Our source material for this is this really comprehensive investment report. I mean, it's absolutely packed with facts, figures, insights about the company and these big changes happening.
Right. And our mission here really is to unpack this report together for you. We want to cut through some of the jargon, help you understand what Sunoco LP really is,
Yeah.
how they make their money, what their future looks like with these major strategic shifts, and importantly, what all this might mean for you. Whether you're just curious about how energy gets delivered, or maybe you're even looking at it from a potential investment angle.
Yeah, absolutely. So let's set the stage a bit. Sunoco has this kind of fascinating dual nature. Yes, they are definitely one of the largest fuel distributors you'll find anywhere. That part's true. But they also own significant, really crucial pieces of energy infrastructure, things like, pipelines and terminals. And there's been some big news lately, some major acquisitions that are set to really change their footprint and their business model. Okay, so where should we start? Let's unpack the business behind the brand first.
Let's do that. So at its core, Sunoco LP is an MLP. It's rooted really deeply in energy infrastructure and fuel distribution. And the company has a long history. It actually traces its origins way back to 1886. Wow, 1886.
Yeah. Today, they're headquartered down in Dallas, Texas, and they transitioned to the Sunoco LP name back in 2014.
Yeah.
Before that, they were known as Susser Petroleum Partners.
Susser. Okay.
And maybe just quickly on the MLP structure, think of it as a specific kind of business structure you often see in energy. The key thing is the income is passed through directly to the investors. It avoids corporate taxes at the company level. We can talk more about the implications of that later on.
Right. Okay. So been around a long time, different structures, different names. And the report lays out their operations across three main segments. First, and this is the largest one, right? Fuel distribution.
Yes, absolutely.
Yeah.
This is the dominant part of their business. It covers the wholesale and retail distribution of fuels, gasoline, diesel, jet fuel. And when we say large, we mean large. Sunoco is the largest independent fuel distributor in North America.
Largest independent. Okay.
Yeah, they move approximately 9 billion gallons annually. It's a huge volume. And they serve this vast network, about 7,400 locations across the country. That includes their own Sunoco branded sites, partner branded locations, independent dealers, commercial customers. It's a really wide reach.
9 billion gallons. That scale it's genuinely hard to even picture. It's way more than just, a chain of gas stations. Then you've got the other side, the critical infrastructure part, starting with pipeline systems.
Correct, yeah. This is essential midstream infrastructure. They manage about 14,000 miles of pipelines.
14,000 miles.
These are the critical arteries, right? They transport refined products, crude oil, even ammonia over long distances, from refineries or production areas out to the distribution points. Think of these pipelines as really the backbone that makes their whole distribution network possible and efficient.
14,000 miles. That's like, what, halfway around the Earth in pipelines? That's incredible. And then they have the terminals?
Yes, they operate over 100 strategic terminal facilities.
Over 100.
Yeah. These are key hubs for storage, for managing the product, blending it, processing, all the logistics. The terminals really complement the pipelines and the distribution network. They let Sunoco store fuel close to markets, and it helps them optimize their margins and pricing across the whole system.
So it's really this integrated logistics model then. The midstream assets, the pipelines, the terminals, they aren't just separate businesses. They actually underpin the fuel distribution side, make it more efficient, more reliable maybe.
Exactly. That integration is absolutely fundamental to how they operate. It allows for more efficient sourcing, transportation, storage, delivery of fuel. And that's crucial in a business like fuel distribution, where the margins can be pretty tight.
Okay, that integration makes a lot of sense. So how does all this translate into actually making money? Because you mentioned earlier it's sort of a balance between volume and stability.
That's a really key insight from the report, yeah. Their revenue primarily comes from that huge volume in fuel distribution. But the stability, the financial stability, is strongly supported by that fee-based midstream infrastructure we just talked about. And the nature of those revenue streams is quite different in each segment.
Okay, tell us more about that difference. How do they contrast?
Well, the fuel distribution revenue is very volume dependent. Simple equation.
Mm-hmm.
The more fuel they move across their network, the more revenue they generate. But as we mentioned, it's typically a low-margin business per gallon.
Right.
So, for example, in the first quarter of 2025, they sold 2.1 billion gallons. Their fuel margin in that quarter was 11.5 cents per gallon.
11.5 cents a gallon. That sounds, wow, incredibly thin for moving billions of gallons.
It is, relatively speaking, especially for a wholesale distributor. But the report actually notes this was a pretty healthy margin in this specific context. And it was actually up slightly from 10.9 cents in Q1 of 2024. So that shows they are actively managing those margins pretty effectively, even in a highly competitive market.
Okay, managing it well. But still, thin margins. Now, compare that to the midstream assets, the pipelines and terminals. That's where the stability comes in.
Precisely. This is where you get that stable, largely fee-based income.
Fee-based meaning.
Meaning it's less susceptible to those big, unpredictable swings in commodity prices, like crude oil or gasoline prices going up and down. They charge fees for moving product through their pipelines or storing it in their terminals, mostly regardless of the actual price of that product.
Gotcha.
So in Q1 2025, their pipeline systems averaged about 1.3 million barrels per day in throughput, and that contributed $172 million in adjusted EBITDA.
Okay, adjusted EBITDA.
Yeah.
Maybe just for listeners who aren't, deep in finance speak, what does that represent in simple terms?
Yeah, good point. Adjusted EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization, with some specific one-time adjustments taken out. It's a really common metric in this industry. Think of it basically as a proxy for the operational cash flow the business generates, before you account for financing costs, taxes, or those big non-cash charges like depreciation. It's seen as a good way to compare the core operating performance of different assets or companies side by side.
Got it, like operational cash flow. So the pipelines brought in $172 million of that in Q1. What about the terminals?
The terminal segment had throughput of roughly 620,000 barrels per day, and that generated $66 million in adjusted EBITDA in that same quarter.
Okay, so that significant fee-based income from the infrastructure, that provides the crucial predictable buffer you were talking about.
Yes, exactly. That balance is a critical strength of Sunoco's model. The stable, fee-based income from midstream provides a really significant buffer against the inherent volatility and those lower margins in the fuel distribution segment. This enhances their financial resilience, it gives them flexibility, and it's absolutely key to supporting those consistent distributions they pay out to their unit holders.
Right, the payouts.
And the report even specifically noted that the recent Tanquid acquisition, one of the big deals we'll talk about, was strategically important because it directly adds more of that stable fee-based income profile. That balance is what gives them a much steadier financial footing overall.
That makes a lot of sense. So they have this established integrated business, this balanced model, and it sounds like they're growing that model dramatically right now with some really big deals.
Let's talk about that expansion and their geographic reach.
Yeah, their current footprint is already quite broad. They cover over 40 U.S. states, Puerto Rico. They have a presence in Europe and Mexico, all supported by that, 14,000 miles of pipeline and over 100 terminals we mentioned earlier. Right.
But yes, the recent impending acquisitions are set to significantly expand that network and potentially transform the company.
Okay, the biggest one that really jumps out from the report is a Parkland Corporation deal. That sounds massive.
That is indeed a transformative acquisition. It's a pending deal valued at $9.1 billion, and that includes assumed debt.
$9.1 billion.
Yeah. This acquisition, when it closes, which is expected sometime in the second half of 2025, it's projected to establish the combined entity as the largest independent fuel distributor in the entire Americas.
Wow. Largest in the Americas. Okay.
Yeah.
Where does that specifically expand their reach geographically?
It significantly expands their presence into Canada. It adds substantial coverage in the Pacific Northwest and the upper Midwest of the U.S., and it expands their reach in the Caribbean. It's expected to add about 200 retail locations and over 3,000 dealer sites. That brings their combined network to over 10,000 locations.
10,000 locations.
Yeah. And the rationale stated in the report is pretty clear. Increased market share, significant customer base diversification geographically, and securing more advantaged fuel supply sources. The deal also strategically includes Parkland's Burnaby refinery out in Vancouver. That produces low-carbon fuels, which is an interesting addition given all the talk about energy transition trends.
Yeah, that low carbon fuel piece is interesting. So that's huge growth just in North America and nearby. But they also acquired something significant over in Europe recently, right?
Tankwood.
Yes, the Tankwood GmbH and Co. KG acquisition. This deal is also pending, also expected to close in the second half of 2025. It's valued at about 500 million, including assumed debt.
Hmm.
And Tankwood is Germany's largest independent terminal operator.
Germany's largest, okay.
Yeah, it brings 15 terminals in Germany and one in Poland into the Sunoco network.
So that's the European piece you mentioned earlier, adding significantly to the small footprint they had there before. Exactly. The rationale here is, to immediately gain access to new established European markets. And it further diversifies their cash flows globally with more stable fee-based income from those terminals. It strengthens their overall infrastructure and operational resilience.
Okay. And they already completed another big acquisition last year, the Nustar Energy deal. That added to the scale too, right?
Yes, the Nestar acquisition was completed back in May 2024. This contributed significantly to their increased scale and diversity, particularly in their midstream assets, pipelines, and storage. And it was actually a factor cited by S&P Global Ratings when they upgraded Sunoco's credit rating. Its impact is already factored into management's 2025 adjusted EBITDA forecasts.
Right. So bringing all these together, Nustar done, Parkland and Tankwood pending, what's the overall strategic importance of this really rapid, large-scale expansion they're undertaking?
Well, the importance is multifaceted, really. Firstly, it dramatically enhances their market penetration and scale. It makes them a truly dominant player. Secondly, by diversifying their geographic footprint across North America, and now significantly into Europe, they reduce their reliance on any single region.
Less risk concentration.
Exactly. It mitigates localized risks, whether that's, economic downturns in one state, regulatory changes in a specific country, or even regional supply disruptions. Ultimately, it's about building a larger, more robust, and probably more adaptable business model, one that's capable of operating and, they hope, growing in a dynamic and changing energy landscape.
That makes a lot of sense. Bigger footprint, more diversification, hopefully more resilience. Okay, let's shift gears a bit and look at the financials. Because this is an MLP, and the report emphasizes there are some specific metrics that really matter, especially if you're looking at this from an income perspective, right?
Absolutely. Yeah, when you're looking at MLPs, standard corporate metrics like net income can sometimes be less informative than the cash flow metrics just because of the structure. So the key ones to focus on are distributable cash flow, or DCF, and the distribution coverage ratio, or DCR.
DCF and DCR, got it.
And Sunoco has shown strong cash generation. In Q1 2025, their adjusted DCF was $310 million. That's a significant jump from $176 million in Q1 2024. The report also projects strong per-unit DCF growth, too, from about $9.20 projected for 2025, growing to $10.16 by 2030.
That projected growth, over $10 a unit in cash flow, what does that imply for the future for someone holding the units?
Well, that projected growth isn't just a number on a page, right? It's really the engine that underpins their ability to potentially increase those distributions, the payouts to unit holders over time, or, alternatively, to reinvest that cash back into the business for future returns and growth. It directly impacts what the potential income and the value of this investment could look like for you down the road.
Okay, makes sense. And what about that other one, the distribution coverage ratio, DCR? That tells you if they can actually cover those payouts, right? Is it sustainable?
Precisely. It's a critical sustainability metric. The DCR shows how many times over their distributable cash flow can cover the distribution payments they're making.
Yeah.
And Sunoco's trailing 12-month DCR as of Q1 2025 was a really robust 1.9x.
1.9 times coverage.
Yeah. And that's well above the common sustainability benchmark you often hear, which is around 1.1x, meaning they have 10% more cash than they need. And it's even higher than the 2024 average for large MLPs, which the report pegged around 1.7x.
So 1.9x is a genuinely healthy number. It shows a significant buffer, a cushion.
It absolutely is.
Right.
That provides a substantial safety margin. It means they have plenty of cash flow to cover the current distribution with a significant amount left over. And that excess cash flow can then be used for other important things like paying down debt, funding growth projects, or even potentially increasing distributions faster in the future.
That definitely sounds strong from a sustainability perspective. What about adjusted EBITDA again? We touched on it earlier, but how does the report use it here in the financial snapshot?
Right. Adjusted EBITDA is used to show the overall operational performance of the company across all its segments combined. And Sunoco reported a significant increase here as well. It reached $458 million in Q1 2025, which was way up from $242 million in Q1 2024.
Big jump.
Yeah. And looking at the segment breakdown for Q1 2025, you see fuel distribution contributing $220 million, pipelines $172 million, and terminals $66 million. The report does note the Q1 2024 pipeline figure seemed unusually low due to some reporting factors, but the Q1 2025 numbers show those typical healthy contributions from the infrastructure side.
Okay.
And importantly, management's forecast for total adjusted EBITDA in 2025 is between $1.90 billion and $1.95 billion. And that includes the impact from the NuStar acquisition that's already closed.
Okay, so strong operational and cash flow metrics reported. But the report also mentions the low-margin nature of fuel distribution. How does that play into the overall profitability picture?
It's true. The core fuel distribution business operates on those thin margins per gallon we talked about, that 11.5 cents in Q1 2025, which is healthy for that business line. But the stable income and the higher contribution margins from the midstream assets, the pipelines and terminals, are absolutely crucial. They offset those lower margins and enhance the overall profitability, particularly when you look at cash flow generation.
Right, the cash flow focus again.
Exactly. While the net income figures might sometimes appear lower, maybe due to significant non-cash expenses like depreciation from assets or interest expenses related to past acquisitions, the report really emphasizes why DCF and adjusted EBITDA are often better indicators of the actual cash flow available to the partnership and its unit holders.
That distinction, cash flow versus net income, seems really important for understanding MLPs specifically. Okay, let's talk about the balance sheet now, because they're taking on a lot of debt with these huge acquisitions, right? Parkland, Tankwood.
Yes, that's a critical point the report definitely highlights. As of March 31st, 2025, Sunoco had about $7.7 billion in long-term debt on its books. Their leverage ratio, which is calculated as net debt divided by adjusted EBITDA, was 4.1x in Q1 2025.
4.1 times.
Yeah, and the report notes that aligns with management's long-term target range. However, the pending Parkland acquisition alone includes assuming $3.5 billion in existing Parkland debt, and they're funding the rest of that deal with a mix of equity and new debt, or preferred equity. Tankwood also includes about $300 million in assumed debt.
So that 4.1x leverage ratio is definitely going to jump up significantly once these deals actually close.
It will. Yeah, the report states these acquisitions are expected to result in a, quote, moderate leverage increase post-close. But management has outlined a pretty aggressive deleveraging target. They're aiming to return to that 4x ratio within just 12 to 18 months after the Parkland deal closes.
12 to 18 months, that sounds ambitious.
It is ambitious. S&P, using a slightly different calculation method, which typically results in higher leverage numbers, projects leverage will be closer to 4.5x to 4.8x through 2026, and then dip below 4.5x by the second half of 2027. So a bit longer time frame from S&P.
Okay, still deleveraging, but maybe not quite that fast. How do they plan to achieve that reduction after adding potentially billions in new debt?
Well, it's expected to be relatively quick, primarily because of, one, projected EBITDA growth from the combined larger entities.
Yeah.
S&P projects their combined EBITDA could reach somewhere between $3.45 billion and $3.75 billion through 2027. And two, crucially significant synergy realization from the Parkland deal.
Synergy realization.
Right.
What does that mean in practical terms here? Cost savings.
Yeah, basically cost savings and increased efficiency gained by combining the operations of the two companies. They anticipate achieving $250 million in run rate synergies from the Parkland deal by year 3 post-close.
$250 million a year in savings.
Yeah. That substantial increase in combined operational cash flow from growth and those synergies is what management plans to use to aggressively pay down debt and bring that leverage ratio back down towards their target relatively quickly.
Okay, so the success of the integration, actually capturing those synergies, that seems absolutely key to hitting the deleveraging targets they've set out.
It's paramount.
How is their credit rating looking right now, consisting of all this activity?
S&P Global Ratings affirmed Sunoco's BB Plus stable outlook back on May 7, 2025. This was actually an upgrade from BB just before that, following the NuStar acquisition closing. S&P cited the increased scale and operational diversity the NuStar deal brought.
So an upgrade despite the leverage plans.
Yeah, reflecting the improved business profile. However, the report also notes that S&P explicitly stated they could lower the rating if leverage approaches 5x. So it highlights just how important meeting those deleveraging targets is for maintaining their current credit profile.
Right. Okay. So they're proactively managing debt. They have a plan, but that post-acquisition period is really crucial for executing that plan and getting the leverage back down. How's their current cash position and liquidity look? Are they stretched?
Liquidity actually looks quite strong, according to the report. As of March 31st, 2025, they had no outstanding borrowings on their $1.5 billion revolving credit facility.
Yeah.
That's like their corporate credit card.
Okay. Clean slate there.
Yeah, and their cash position had increased. They've also been proactive in managing their debt structure. They recently completed a $1 billion notes offering, basically issuing new bonds. They used the proceeds to repay some existing debt and part of that revolver, demonstrating financial flexibility. They also expanded their credit facilities specifically to help fund the Parkland deal.
And are they still investing in the business itself? You know,
Uh,
maintaining the assets, maybe growing organically?
Yes, definitely. In Q1 2025, their total capital expenditures, or CapEx, were $101 million. And the report breaks this down nicely. $75 million of that went towards growth capital, so expanding the business, and $26 million was for maintenance capital, just keeping the existing infrastructure running reliably.
Okay. Growth versus maintenance.
Yeah, and that includes their share in joint ventures with Energy Transfer, their parent company. This distinction is helpful because maintenance capital is essentially what's needed just to keep the lights on, keep the pipes safe, while growth capital is money being spent to actually expand the business, build new assets, or improve existing ones for future returns.
That distinction between investing in the future and just maintaining the present is helpful context. Okay, so if you're looking at Sunoco LP as a potential investment, especially maybe for income, what does this all mean for the returns you might expect?
They're an MLP, so distributions, the payments to unit holders are obviously key. Exactly. And Sunoco has a solid track record here. The report highlights they've maintained consistent quarterly distributions for 12 years straight. For Q1 2025, the distribution was 0.8976 cents per unit. If you annualize that, it comes out to 3.5904 DLN per year.
Okay, consistent payments. And have they been increasing that amount over time? Or just keeping it steady?
No, they've been increasing it gradually.
Yeah.
That Q1 2025 payment was actually about a 1.25% increase from the previous quarter, Q4 2024, and they've increased the distribution by about 9% cumulatively since 2022. So the historical data shows a clear pattern of consistent payments with gradual increases over time.
And that strong distribution coverage ratio we talked about, the 1.9x, that directly signals they can sustain those payments, presumably.
It does. Yeah, the 1.9x DCR is a direct measure of distribution sustainability. And as we noted, it's well above the benchmark and the industry average for large MLPs. Management is targeting at least 5% annual distribution growth for 2025. That target seems strongly supported by their robust cash flow generation and that high coverage ratio.
Right.
Remember, a DCR above 1.0x means they actually have cash left over after paying the distribution. That implies they are also reinvesting some of that cash back into the business, which is generally seen as prudent for long-term stability and potential future growth.
Okay, so it's not just about the yield you get today, the cash payout now, but also the potential total return, right?
Yeah.
Combining that distribution income with any potential price appreciation of the units themselves over time.
Correct. And the report notes that Sunoco has delivered a pretty compelling total return historically. Their current yield, as of the report date, was attractive at 6.29%. That's higher than the broader energy sector average yield, which was around 4.83%.
Higher than the average, okay.
However, it's slightly lower than Sunoco's own historical 5-year average yield, which was closer to 8.0%.
Okay, wait, what does that imply? When the current yield is lower than the historical average yield, does that mean the payout hasn't kept pace?
Not necessarily. It actually implies that over the past 5 years, the unit price appreciation has outpaced the distribution growth.
Ah, okay. The price went up faster than the payout did.
Exactly, which leads to that lower current yield percentage compared to the historical average yield relative to the unit price back then. And the unit price appreciation figures in the report bear this out pretty dramatically. 10.9% over the past year. A strong 73.4% over 3 years.
73% in 3 years?
Yeah, and a very significant 240.4% over 5 years, and over 200% over the last 10 years.
Wow. Okay, that clearly demonstrates substantial value creation for unit holders over time, well beyond just the distribution checks. That's significant price growth. Now, you mentioned the MLP structure a couple of times. For anyone thinking about investing, the report really stresses there are some unique tax implications here that are really important to understand, aren't there? This isn't like buying regular stock.
This is a crucial aspect of MLPs, yeah, and the report highlights it clearly. Because they are structured as pass-through entities, the partnership's income, gains, losses, deductions. It all flows through to the individual unit holders. It's taxed only at the individual level, avoiding that potential double taxation you see with corporate dividends. That can be a potential tax advantage.
Okay, avoids corporate tax. How about the distributions themselves? How are they taxed?
Generally, the distributions you receive are considered a return of capital. This portion of the distribution is typically tax deferred because it reduces your cost basis in the units you own.
Reduces your cost basis, meaning?
Meaning you don't pay tax on that part of the distribution right away.
Yeah.
You only pay tax on it when you eventually sell your units, or if your cost basis gets reduced all the way down to zero over time.
Okay, so tax is deferred via reducing the cost basis. How about the tax reporting itself? Is it simple?
This is where it gets a bit more complex for many people. For tax reporting, instead of receiving a simple Form 1099 like you would for stock dividends, you receive a Schedule K-1.
K-1.
Yeah. This K-1 details your specific share of the partnership's income, deductions, gains, losses, credits, etc. And it can definitely make tax preparation more complex. Sometimes it really requires using a tax professional who is familiar with MLPs and K-1s.
So potentially more complicated tax filing. And what happens when you eventually sell your units? Is it just capital gains then?
Not quite that simple, unfortunately. When you sell, you might face taxes on both the capital gain, the difference between your selling price and your adjusted cost basis, and you might also have to pay ordinary income tax on something called recaptured depreciation. That's essentially taxable income that was allocated to you over the years, which reduced your cost basis but wasn't taxed at the time. So potentially 2 layers of tax upon sale.
Ordinary income tax too. Okay. Any potential upsides on the tax front besides the deferral?
The report does mention a potential benefit. MLP income may be eligible for the qualified business income or QBI deduction. That was part of the 2017 tax changes. If eligible, that QBI deduction can further reduce your effective tax rate on that MLP income.
Okay, so potential tax advantages like deferral and maybe QBI, but definitely added complexity with the K-1 and the potential tax upon sale. What about holding MLPs in retirement accounts, like an IRA? Is that simpler?
Oh, this is where it gets really interesting, and you need to be cautious. Holding MLPs directly in tax-advantaged retirement accounts like IRAs can actually generate something called unrelated business taxable income, or UBTI.
UBTI, what's that?
Yeah. If your UBTI from all sources within that retirement account exceeds $1,000 in a given year, it can actually trigger taxes within the retirement account itself.
Taxes inside your IRA. Doesn't that defeat the purpose?
It can, yeah. It potentially negates some of the tax advantage benefits of holding them there in the first place. So for retirement accounts, the report suggests considering MLP exchange-traded funds, or ETFs. These ETFs hold MLP units, but they issue a standard 1099 form to investors instead of a K-1. That structure generally avoids the UBTI issue for the end investor.
Okay, so direct ownership in an IRA needs careful thought due to UBTI. Definitely seems like consulting a tax professional familiar with MLPs is a good idea before jumping in directly.
Highly recommended, yeah. That tax complexity is a really key consideration.
Absolutely. Okay, let's zoom out a bit now and look at the big picture. The competitive landscape, the risks they face day to day and long term, and where Sunoco really fits into all of that.
Right. The industry structure itself is kind of split, as we've discussed. Fuel distribution is known for being highly competitive. It's quite fragmented with lots of players, and it's characterized by those thin margins we talked about.
Lots of competition, tight margins.
Yeah. The midstream sector, on the other hand, pipelines, terminals, that's very capital intensive to get into. It's generally more consolidated, fewer large players. It's characterized by more stable, often fee-based or long-term contracted revenue streams. Sunoco strategically leverages the stability it gets from owning those midstream assets to support its higher volume, lower margin fuel distribution business. It's that integration again.
Okay. And where do they stand in terms of market position, market share within this landscape?
Well, as we mentioned, they are already the largest independent fuel distributor in North America. They distribute around 9 billion gallons annually, holding a significant share of the wholesale market. And that pending Parkland acquisition is set to dramatically boost this scale, making them the largest independent fuel distributor across the entire Americas. It really solidifies their leadership position.
So, a dominant player, getting even bigger. What gives them a competitive edge in this landscape? Do they have what you might call a moat around their business, something that protects them from competitors?
Yes, the report identifies several key competitive advantages that combine to build a pretty strong moat. First, their extensive infrastructure that 14,000 miles of pipelines, the 100-plus terminals, represents a massive asset base. It's a significant barrier to entry for potential competitors. It's incredibly costly and time-consuming to replicate that kind of network.
Hard to copy.
Very. Second, there's strong brand recognition. The Sunoco name has been around for over a century. That fosters customer loyalty, especially on the retail side. Third, a significant advantage is their reliance on long-term contracts. Their midstream assets are primarily fee-based and highly contracted, and their fuel distribution involves long contracts, often 7–10 years, with their branded dealers who exclusively sell Sunoco fuel. This provides crucial revenue predictability.
Locking in that revenue.
Exactly. They also have that integrated logistics and supply strategy we talked about, allowing them to source fuel cost effectively and optimize margins across their system. And finally, their underlying real estate portfolio adds another layer of stable cash flow.
Okay, quite a few advantages building that moat. If we apply maybe a quick Porter's 5 forces analysis looking at competitive pressures, what does that tell us about the industry dynamics they face?
Sure. In terms of buyer power, it's probably moderate to high in fuel distribution because fuel itself is largely a commodity and the market's competitive. But Sunoco mitigates this significantly with those long-term contracts and their brand loyalty. Supplier power is also seen as moderate to high. The report specifically notes a risk due to their reliance on a limited number of key fuel suppliers for their product. That's a potential vulnerability if one supplier has issues.
Relying on just a few big suppliers.
Okay. The threat of new entrants is generally seen as low to moderate, mostly due to the high capital needed to build competing infrastructure and the significant regulatory hurdles. It's very hard for a new player to come in and compete with their established network scale. Rivalry among existing competitors is high, however, especially in that fragmented fuel distribution market. That puts constant pressure on margins, demanding efficiency and scale to succeed.
Makes sense. And the last force, the threat of substitute products. That feels like a really big one looking ahead, particularly with the energy transition discussion.
Absolutely. This is rated as moderate in the short term, but HIGH in the long term. The primary substitute clearly is alternative energy sources for transportation, most notably electric vehicles, EVs. Projections cited in the report show an expected decline in traditional gasoline and diesel demand, maybe 2–3% per year over the long term, alongside significant growth projections for the EV market. This represents a fundamental structural headwind and a major long-term threat to their core business model, which is built around distributing those traditional fuels.
Okay, that's a big one. Let's talk about those risks and challenges more directly because the report details several key ones. You just mentioned the energy transition as a major long-term threat.
It is indeed. The increasing adoption of EVs, ongoing improvements in fuel efficiency for traditional vehicles, policy efforts around the world aimed at decarbonizing transportation. It all poses a significant structural headwind. Now, Sunoco is exploring some nascent small investments in things like EV charging infrastructure at some locations and alternative fuels like hydrogen, biodiesel, compressed natural gas, CNG.
They're dipping their toes in.
Yeah, but these efforts are currently very small compared to the vast scale of their traditional fuel operations. Their ability to effectively adapt their business model over the coming decades and potentially pivot more significantly towards new energy sources will be absolutely crucial for their long-term relevance and value. It's worth noting the Parkland deal does bring some existing low-carbon fuel production capabilities and some EV charging experience, which is at least a start in that direction.
It's a start, but a long way to go maybe. What other risks are they facing right now, aside from that major long-term trend? Regulatory ones, I assume. Energy is heavily regulated.
Yes, definitely. The energy sector is heavily regulated at the federal, state, and local levels, in basically all the regions they operate: U.S., Canada, Europe. This means significant ongoing compliance costs just to meet environmental standards, safety regulations, transportation rules, and future changes or new policies, perhaps specifically aimed at curbing hydrocarbon growth or accelerating the energy transition even faster, could introduce new challenges, increase their costs significantly, or even directly impact the viability of some of their core assets over time.
Makes sense. And commodity price volatility. Even with those stable fee-based assets, the huge fuel distribution side must still have some exposure to fluctuating oil and gas prices.
It does, yeah. While the midstream fee-based income provides that significant buffer we discussed, big fluctuations in crude oil and refined product prices can still impact fuel demand and squeeze or expand those distribution margins. However, the report notes the company has shown resilience in managing this volatility. Sometimes they can effectively offset lower volumes with higher per gallon margins through their pricing and supply optimization strategies. But it's still a factor they have to manage constantly.
Okay. What about supply chain risks? You mentioned earlier they rely on a limited number of key suppliers. Is that a major concern?
It's noted as a vulnerability, yes. That reliance on a limited number of principal fuel suppliers means that any significant disruption affecting one of those major suppliers, whether it's due to refinery issues, transportation problems, geopolitical events, whatever, could potentially impact Sunoco's ability to reliably procure and distribute fuel efficiently. That could lead to temporary shortages in certain areas or increased fuel acquisition costs for them.
Right. Less diversification in suppliers. And the massive acquisitions they're undertaking right now, integrating Nustar, Parkland, and Tankwood all around the same time must come with substantial integration risk, right? That sounds incredibly complex.
Absolutely. Integrating multiple large businesses simultaneously, especially one as complex and international as Parkland, and another establishing a major presence in a new European market like Tankwood. It's a massive undertaking.
Yeah.
And it carries substantial execution risk.
Execution risk meaning they might mess it up.
Essentially, yeah.
Challenges include successfully merging different operational systems, IT infrastructure, logistics networks, supply chains, and even just different corporate cultures. Crucially, if they fail to successfully integrate these companies smoothly, or if they fail to capture those projected $250 million in annual synergies from the Parkland deal as planned, it could negatively impact their financial performance. It could hinder those deleveraging efforts we talked about, and ultimately mean the deals fall short of delivering the projected growth and value. And the report mentions Parkland's complex financial structure adds yet another layer of integration complexity to manage.
And that ties directly back into the debt and leverage risk we discussed earlier. Failure to integrate means failure to deleverage quickly. It does. They are tightly linked. While they have that deleveraging plan supported by projected cash flow growth and those crucial synergies, the significant increase in debt post-acquisitions definitely elevates financial risk in the short to medium term. Meeting their aggressive deleveraging targets is paramount. Any significant delays in integration, unexpected performance issues in the acquired businesses, or even just a prolonged high interest rate environment could impede that deleveraging progress. That, in turn, could potentially lead to a credit rating downgrade from S&P or others, which means higher borrowing costs in the future, and just generally reduced financial flexibility for other investments, or returning cash to unit holders. Remember, S&P noted they could lower the rating if leverage approaches 5x.
Right, the 5x threshold. Speaking of interest rates, as a capital-intensive MLP with a lot of debt, both existing and newly acquired, they must be pretty sensitive to changes in interest rates overall.
Yes, they are. Rising interest rates increase borrowing costs. That applies both to new debt they issue, like bonds, and potentially to any variable rate debt they hold, like their revolving credit facility if they draw on it. Their recent $1 billion notes offering, for example, came with a higher interest rate 6.250% than some of the older debt it was intended to replace, which carried a 5.750% coupon. That shows the increased cost of borrowing in the current environment.
So higher interest expense.
Yeah. A sustained high-rate environment could increase their overall interest expense significantly, which directly impacts profitability, and could potentially slow down their ability to finance growth projects or deleverage using their free cash flow. It just makes everything more expensive.
Okay, so lots of moving parts, significant growth plans, but also some very real challenges and risks to navigate. Who is leading the company through this complex period? What does the report say about the management team?
Sunoco LP is led by an experienced management team. The executive team, as noted in the report, has an average of about 25 years of experience in the petroleum sector. So, deep industry knowledge. The report highlights key members like the president and CEO, Joseph Kim. He has a diverse background that includes technology roles before coming to Sunoco, which could potentially be beneficial as they navigate these complex integrations and also think about the longer-term energy transition.
Tech background, interesting.
Yeah. The report generally suggests a track record of consistent execution of strategy, citing the previous successful integration of the Nustar acquisition and their stated financial discipline around deleveraging targets. This indicates they are capable of managing these complex initiatives. However, it's fair to say the scale of the current pending deals, Parkland and Tankwood combined, is unprecedented for the partnership. So it's a major test.
A big test indeed. And what about the corporate governance structure? You mentioned they are an MLP and they're related to Energy Transfer, right? That has some specific implications that investors need to understand.
This is a critical aspect of the MLP structure and governance that the report explicitly points out for potential investors to consider carefully. Sunoco LP is managed by its general partner, which is a separate entity called Sunoco GP LLC. Now, this general partner is 100% owned by Energy Transfer LP, or ET.
Okay, owned by Energy Transfer.
Yes, and ET also holds a significant limited partner interest in Sunoco LP itself, and importantly, ET owns all of Sunoco LP's incentive distribution rights, or IDRs.
IDRs, what are those quickly?
IDRs are basically a special class of equity, common in older MLP structures, that gives the holder, in this case ET, an increasing percentage share of the partnership's distributable cash flow as the distribution payouts reach certain target levels and grow over time. So this entire structure gives ET substantial influence and effective control over Sunoco LP's strategy, its operations, and major decisions like acquisitions or distribution policies.
Okay, significant control by Energy Transfer. And the report mentions this structure actually limits the fiduciary duties of the general partner. What exactly does that mean for you if you're just a common unit holder of Sunoco LP?
This is a really key point, and it's different from a regular corporation. In a traditional corporation, the management team and the board of directors have a legal fiduciary duty to act in the best interests of all the shareholders. In the Sunoco LP MLP structure, the report explicitly states that the partnership agreement, the legal documents, limit the fiduciary duties of the general partner, which is ET-owned, and its affiliates.
Limits their duty.
It means the general partner is not legally bound to act solely in the best interest of Sunoco LP's common unit holders. Decisions made by ET regarding Sunoco LP could potentially be influenced by ET's own broader portfolio strategy, its own financial needs, or other considerations within the larger Energy Transfer empire, rather than focusing only on Sunoco LP's standalone performance or the sole interests of its public common unit holders. This potential for conflicts of interest between the general partner ET and the common unit holders is a fundamental governance consideration and, frankly, a risk for investors in many MLPs, including this one.
That's definitely something very important to be aware of before considering an investment. That alignment might not always be perfect. What about the board of directors of Sunoco LP itself? Do they provide independent oversight?
The board does provide oversight. The report noted a recent change, actually, with the retirement of a long-serving board member, Christopher Curia, effective May 1st, 2025. His departure was stated as personal, and no replacement was named at the time of that filing. While board turnover is natural, this does highlight the ongoing importance of succession planning and the need for investors to monitor future board appointments, especially given the significant influence held by the general partner, Energy Transfer.
Right. The GP's influence looms large there. Okay, so considering all of that information, the integrated business model, the financials and strong cash flow metrics, the massive growth plans via these acquisitions, the significant risks involved, integration, leverage, transition, the valuation picture, and that unique governance structure, how is Sunoco LP valued currently? And what's the overall investment takeaway presented in this specific report?
Okay, for valuation. Well, standard metrics like the price-to-earnings, PE ratio, exist. It was around 9-10x, according to the report, and price-to-sales was low at 0.36x. MLP valuation is typically centered more on cash flow generation, specifically that distributable cash flow, or DCF. So metrics like price-to-DCF are often considered more relevant. Historically, Sunoco has traded in the mid to high single digits on that metric. The current distribution yield, 6.29% at the time of the report, is attractive compared to the broader energy sector average.
And considering that projected DCF growth we talked about, potentially rising to over $10 per unit by 2030, how does that factor in?
That projected DCF per unit growth is a really key input for cash flow-based valuation models. It suggests increasing intrinsic value potential over time, assuming they execute on their plans and achieve that operational performance. The report also touches briefly on scenario analysis, basically, reinforcing that the actual outcomes depend heavily on the success of integrating Parkland and Tankwood, that's the bull versus bear case, overall economic conditions, and critically, the pace of the energy transition we discussed.
Makes sense. The outcome isn't guaranteed. Okay, so bringing it all together then, what is the final investment recommendation presented in this report based on everything we've covered here today?
The bottom line recommendation in the source report is BUY, and they provide a target price range of $68 to $75 per unit.
A buy rating, $68 to $75 target. Why? What's the core justification presented for that recommendation and that price range?
The justification presented centers on several key points we've discussed throughout this deep dive. First, it's highlighted as a high-yield investment opportunity with a strong track record of consistent and growing income distributions. Second, this income is underpinned by resilient energy infrastructure assets that provide a stable base of fee-based cash flow. Third, those strategic acquisitions of Parkland and Tankwood are viewed as significant catalysts for future growth and cash flow enhancement. They're expected to be immediately accretive to DCF per unit, meaning they should boost cash flow available per unit right away after closing, and they're expected to generate substantial synergies and operational benefits over the next few years.
So the deals are seen as a positive driver.
Yes, a major one. Fourth, their current financial health is seen as strong, evidenced by that robust DCF generation and the very high 1.9x distribution coverage ratio. That strongly signals distribution sustainability and capacity for future growth. Fifth, management has clearly communicated a commitment to at least 5% annual distribution growth for 2025 and disciplined deleveraging following the acquisitions. Plus, they have an experienced management team, that extensive, difficult-to-replicate infrastructure network, increasingly diversified revenue streams balancing fee-based stability with volume-driven distribution, and those competitive advantages we discussed that should help them navigate the risks. And finally, the report argues the current unit price, at the time it was written, was attractive relative to its cash flow generation power and the growth prospects anticipated following these major deals.
Okay, that covers the buy part. What about the target price range, $68 to $75? How did they arrive at that?
That $68 to $75 range reflects the anticipated uplift in value that could come from successful execution. That means successful acquisition integration, capturing those $250 million in synergies from Parkland, and realizing that continued DCF and distribution growth they project. The report notes this range aligns with or is slightly above the recent analyst consensus targets, which had been more in the $61 to $68 range, with some analysts raising targets towards $66 after recent updates. The justification provided in the report for targeting the higher end of that range, or maybe above $66, is specifically based on that projected strong DCF for unit growth towards $10 by 2030 and the expected immediate accretion from the acquisitions, assuming successful execution. That assumption is key.
Right. Assuming successful execution is the big caveat there. So the report is essentially saying that while there are significant risks, particularly around integrating these massive acquisitions, managing the resulting leverage, and navigating the long-term structural threat of the energy transition, the company's solid foundation, its strong current financials, the clear growth catalysts from the deals, and management's articulated plan make it an attractive opportunity at the current price. Especially for income-focused investors looking for yield and potential growth, provided they understand and are comfortable with the unique MLP structure and governance.
Yeah, that summarizes the report's core investment thesis very well.
Yeah.
Though, it absolutely bears repeating one last time. For any potential investor listening, those MLP tax complexities involving the K-1 form and potential UBTI issues, and that unique governance structure involving Energy Transfer LP with its limited fiduciary duties. These are fundamental considerations. They require careful personal thought and potentially professional advice tailored specifically to your own situation before investing.
Absolutely critical points. So let's wrap this up. What does this all mean for you, the listener? Sunoco LP, the company behind those familiar pumps you see on the road, is clearly far, far more than just a gas station operator. It's a major player in energy logistics with a balanced business model that strategically uses stable infrastructure assets, pipelines, terminals to support its massive fuel distribution business across a huge network.
And they are actively undertaking these significant, potentially transformative acquisitions right now, aimed at boosting growth, adding more stability, and expanding their footprint dramatically across the Americas and now into Europe as well. This aggressive growth strategy is backed by strong current financial metrics, like that robust distributable cash flow and a high distribution coverage ratio, suggesting the current payout is well supported.
This deep dive matters because it gives you insight into a key piece of the energy supply chain that's literally fueling transportation across vast regions every single day. And, as presented in the report, it represents a potential investment opportunity focused on income and growth.
But, as we've stressed throughout, it comes with those unique complexities of the master limited partnership structure, the tax implications, the K-1 form, the governance relationship with Energy Transfer LP, that really need careful consideration before you make any decisions.
It really does make you think, doesn't it, about the incredible complexity hidden in plain sight when you just pull up to the pump to fill your tank.
Mm.
As we wrap up this deep dive, let's leave you with maybe something to ponder, connecting Sunoco's business to the bigger picture out there. Sunoco is making these massive bets right now on expanding its traditional fuel distribution and logistics network. They're effectively doubling down on moving gasoline and diesel efficiently at scale, even as they're exploring these, much smaller, nascent investments in things like EV charging and alternative fuels.
So the question becomes, how quickly will the world truly shift away from gasoline and diesel for transportation over the coming decades? It's the multi-trillion-dollar question, right? And can large infrastructure companies like Sunoco, with these deeply embedded assets in traditional fuels, successfully adapt and thrive in that changing energy future?
Or will their core, currently valuable pipeline and terminal assets eventually become a liability in a world that's moving towards decarbonization? What stands out to you about this deep dive into Sunoco LP?